When most beginners start investing, they spend hours choosing specific funds or stocks. Decades of research suggest that this is the wrong place to begin. The single biggest decision in long-term investing is usually not which stock to pick. It is the split between different types of investments overall. That split has a name. It is called asset allocation. Asset allocation is simply how you divide your investments among broad categories. The most common categories are stocks, bonds, and cash. Some allocations also include real estate, commodities, or other assets. Each category behaves differently. Some grow more but bounce around more. Some grow less but stay calm. Choosing the mix is the real heart of any investment plan. Stocks represent ownership in companies. Over long periods, they tend to grow the most, but they also experience the biggest drops along the way. Bonds represent loans to governments or companies. They tend to grow more slowly but also fall less. Cash and short-term savings barely grow at all, but they almost never fall in dollar terms. Together they form a balanced toolkit. A useful metaphor is a small farm. Stocks are like fast-growing crops. They yield more in good seasons but are vulnerable to storms. Bonds are like sturdier crops. They produce less but survive bad seasons. Cash is like a small supply of grain in storage. It does not grow, but you can always reach for it. The mix of crops determines how the farm performs across all seasons. The most important factor in choosing your asset allocation is your time horizon. If you are decades away from needing the money, you can usually accept more short-term ups and downs. Stocks can dominate the mix. If you will need the money in a few years, you cannot afford large drops at the wrong moment. Bonds and cash should play a larger role. Another factor is your tolerance for volatility. Some people sleep peacefully while their stock portfolio falls 30% during a tough year. Others lose sleep at much smaller drops. The right allocation respects this honestly. A plan that looks great on paper but causes you to sell during a downturn is much worse than a slightly less optimal plan you can actually stick with. A common starting point for beginners is a simple split between a broad stock fund and a broad bond fund. The exact percentages depend on age, goals, and comfort. A long-running rough rule used by many is to subtract your age from 100 or 110, and use that number as your stock percentage. The rest goes into bonds. Many variations exist. A common misunderstanding is that asset allocation is something you do once and forget. Markets move. Stocks may surge for several years and quietly tilt your allocation far away from your original plan. A portfolio that started at 70% stocks can easily drift to 85% stocks during a long bull market, taking on more risk than the investor originally chose. The solution is rebalancing. Periodically, perhaps once a year, you sell a little of whatever has grown most and buy a little of whatever has lagged, bringing your mix back to its target. This sounds counterintuitive, but it quietly enforces a simple discipline. Trim what is high, add to what is low. Done with patience, it tends to reduce risk over time. A practical example helps. Imagine someone with a 70% stock and 30% bond target. After a strong year, stocks now make up 80% of the portfolio. They sell enough stock to return to 70% and use the proceeds to buy bonds. The next year may be the opposite. Over years, this slow rotation quietly captures gains and refills cushions. What beginners often misunderstand is the role of cash. Cash is not just leftover. It is part of the plan. Holding a meaningful cash cushion outside the investment portfolio, perhaps in a high-yield savings or money market account, prevents you from being forced to sell investments at a bad time. This emergency layer is the foundation underneath any asset allocation. There is a psychological angle worth noticing. Investors who pick an allocation honestly aligned with their own temperament tend to behave better in downturns. They expect bumps. They do not panic. The investors who choose aggressive allocations only because they sound smart often abandon their plan in the first serious downturn, locking in losses. Self-knowledge is part of asset allocation. A practical rule is to write down your target allocation, in plain language, on a single sheet of paper. Include the percentages, the rebalancing schedule, and the reasons behind the choice. When markets get loud, return to this sheet. It is much harder to panic into selling everything when you have already promised your future self what your plan looks like. What to avoid is chasing whatever asset class is performing best at the moment. After a strong stock run, it is tempting to load up on stocks. After a bad year, it is tempting to flee into cash. Both behaviors quietly buy high and sell low, year after year. A preset allocation, followed patiently, defends you against your own future emotional decisions. A better habit is to gradually shift your allocation as life changes, not as markets do. As you approach a major goal, like retirement, gradually move more of the portfolio toward less volatile assets. As your income grows and your stability improves, you may keep a similar allocation but contribute more each year. Life events drive change, not headlines. Over the long term, two portfolios with similar funds but different allocations can produce dramatically different experiences. The one that matches an investor well allows them to stay invested through both quiet years and stormy years. The one that does not match them often gets abandoned at the worst possible moment. Allocation is not about maximum return. It is about durable participation. The investor who participates through every cycle, even imperfectly, almost always ends up ahead of the more talented investor who keeps stepping in and out at the wrong moments. To summarize, asset allocation is the percentage split among broad investment categories such as stocks, bonds, and cash. It depends on time horizon, temperament, and goals. It must be revisited periodically. It works best when chosen honestly and followed patiently. It is the quiet engine behind most of what determines long-term investment outcomes. The choice of allocation matters far more than the individual products inside it, which is why even the most experienced investors return to this question again and again across their lives. The final takeaway is gentle. You do not need to pick perfect investments. You need to pick a reasonable allocation, contribute consistently, rebalance occasionally, and avoid emotional decisions. Years from now, the quiet, unglamorous discipline of staying with your allocation will likely have done far more for your wealth than any single brilliant pick ever could. The most exciting financial transformations almost always come from boring repeated choices made well, not from clever bets made occasionally. Allocation is the quietest of those boring choices, and possibly the most important. Time and patience handle the rest, working in your favor whether you are watching closely or not.